Mortgage interest rates are in big trouble as Powell signals for higher rates after being pressed by lawmakers, saying that the interest rate pause is expected to be temporary. In fact, his exact statement is, given how far we've come, it may make sense to move rates higher, but do so at a more moderate pace. In his testimony this past week, Federal Chairman Jerome Powell affirmed that more interest rate hikes are likely ahead as inflation is well above where it should be, saying that inflation pressures continue to run high and getting inflation back to the 2% target has a long way to go. With that said, there are a couple of things that Powell said in the testimony that I think are worth quoting here because it really lets you into the mindset of the Fed, what they're thinking, and more importantly, what they're likely to do over the next couple of months. Now, I'd like to take a minute and ask a favor. If you find any value in my videos at all, do me a favor and hit that thumbs up. It takes a lot of time to create these videos on top of being a real estate agent. So do me a favor and also subscribe to the channel to stay updated on everything real estate related. The first thing he said is a strong majority of the committee feels there is a little further to go with rate hikes. On top of that, he mentioned that his views aligned with the majority, basically saying that he also believes a couple of more rate hikes might be necessary. In addition to that, he said we haven't seen much progress in service sector inflation, basically saying that he would like to see inflation come down in areas where it hasn't yet moderated, which is another reason they believe that the rate hikes might be necessary. And lastly, the most important thing he said here, which to me is the most scary, is saying that it will be appropriate to raise 2 more times this year if the economy evolves as expected. And here's the important part. Somebody asked, well, what does as expected mean? And he said continued modest growth plus continued cooling of the labor market plus continued cooling of inflation. In other words, what he's saying is 2 more rate hikes don't necessarily require inflation remaining stubbornly high or the economy showing signs of resilient growth, more or less confirming that the Fed is actually expecting the labor market to weaken. They're expecting job numbers to weaken. They're expecting the economy to slow down a little bit. And that's not necessarily going to mean that they're going to back off their hikes. They're more or less affirming that, hey, even though we see the employment numbers get worse, we see the economy slow, that doesn't mean we're going to back off this hawkish stance. We still believe there are 2 more rate hikes needed in order to get inflation out of control. And that's super important because the U.S. jobless claims data is still sitting at the highest levels that we've seen since October of 2021, with California, New Jersey, and Connecticut seeing the biggest increases. But here's the thing. We all think that as unemployment gets worse, jobless claims data goes up, that the Fed is going to become a little bit more dovish and back off their stance. But what the Fed is saying right now is that they're actually expecting what is happening right now and that it's not likely to change their stance on continuing to hike rates. And what this has done is more or less create volatility in the market. You know, if you've heard me talk in previous videos, I've said that I expected interest rates to come down as we start to see inflation moderate. And we've seen inflation come down. In fact, this time last year, inflation was sitting at 9.1%. This year, inflation is sitting somewhere around 4%. In fact, when we get the July print for June inflation, we're likely going to be sitting somewhere around 3% with year-over-year inflation. And even though we've seen inflation come down, what we've seen is interest rates more or less bounce. We've seen interest rates trade somewhere between 6 and 7% since the start of the year. In fact, we saw interest rates peak back in October of last year, and then we started to see those numbers come down. And as we saw those numbers come down, what we saw is buyer demand pick up. And with that, we actually saw U.S. home sales pick up as well. But along with that, we saw prices drop the most since 2011. And that's because we saw the median sales price decline by 3.1% year over year. Now, before you get all caught up in home prices declining by 3.1% year over year, understand that the median isn't the best number to go off of. And the reason for that is because as housing gets more expensive, housing affordability starts to play a part. You have less able buyers out there in the market able to purchase at the higher end of the market. And with that, you just have less transactions happening on the higher side. Instead, what you have is more transactions happening in the lower end of the market, typically below the median home price, and it pulls that median number down. So understand when you hear something like the median home price has declined 3.1% or 5% or 10%, whatever it is in your market, please know that that doesn't necessarily mean that home prices in your bracket, in your market, have declined by that same percentage. You might have the median home price declining by 3.1%, but in your market, you're actually seeing home prices go up. And that's because real estate is local. Not all areas of the United States, not all markets react the same way. In fact, if you're in a market that has a higher median home price, you're likely to see bigger declines in those markets because less people can purchase at the high side as interest rates stay stubbornly high. And that's another reason why you're seeing home sales barely budge from April to May in what they're calling a sluggish spring housing market, as sales are down nearly 20% year over year. Now that's mostly due to higher interest rates, but it's also due to the lack of supply, as in May, we're seeing the lowest level of inventory that we've seen in nearly a decade. And with that, also understand that the US housing market still needs about 4.3 million homes in order to close that affordability gap. And because of the overall lack of supply in the market, all those homes that we need, that's exactly why we're seeing America's housing shortage keeping prices high. And with that, Redfin is reporting that there's 40% fewer homes on the market now than pre-pandemic. So for anyone out there waiting for all of this inventory to come to the market that's going to bring house prices down, I ask you right now to put in the comments, where is that inventory going to come from? And while you're answering that question, I'll address a couple of the things that people are going to say. They're first going to say that it's going to come from foreclosures when the recession hits and all of these people get laid off. Well, please understand, tappable equity is currently sitting at all-time highs. So with that, there will be some people that get laid off and need to sell their homes. But understand, only distressed sales are what bring home prices down in any significant way. So yeah, there might be some homes coming to the market, but most of these people are going to be able to sell their homes at market value. So it's not going to be a distressed situation. In addition to that, there's currently about 10 million available jobs out there in the market, which means that if someone gets laid off from their job, there's a really good chance that they can go find another job. In addition to that, many of the people that get laid off during recessions are those at the lower end of the totem pole, if you will. And many of those people aren't homeowners to start. And that's not a dig on the lower echelon of society, if you will. It's just a fact that just because a recession happens and unemployment goes up doesn't necessarily mean that everyone is going to lose their homes and there's going to be this big flood of inventory coming to the market. And the second thing I want to touch on with regards to supply is back about 6 months ago, everyone believed that new construction was going to be the fall of the housing market. All of this construction out there that was coming due was going to be the collapse because all of this supply was going to hit the market, essentially bringing prices down. Well, here's the bad news. Builder confidence just rose to the highest levels that we've seen in quite some time, beating expectations, which means that home builders out there are gaining confidence about the housing market. And it's largely due to that lack of supply. And that's exactly why we're seeing US housing starts rise, beating expectations, with nearly 1 million new homes in the pipeline. So builders are out there looking at the market, looking at buyer demand, and looking at the lack of inventory, saying that, hey, because of this lack of inventory out there, we are actually in an advantageous situation because at the moment, new construction makes up nearly 25% of the current inventory, meaning that if you're a home buyer out there looking to buy a home, there's a really good chance that your only option in some markets might be new construction. And that's exactly why you're seeing new US home construction surge by the most in 3 decades at a time out there when many people are wanting the housing market to crash. So here's my take on what's actually happening in the housing market at the moment. What we've seen is interest rates actually pull back a little bit off the recent highs, falling for the third week in a row, but it's really just a little movement in mortgage rates. You're not seeing any significant decreases or increases in rates, which is exactly what I think is going to happen over the next couple of months, which is going to continue to lead to a slower summer of home sales. You're just going to have less transactions out there in the market. You're going to have less people buying homes because of housing affordability on top of seasonality, right? This is a slower time of the year as we move through summer. And with that, the data is going to continue to get worse as they compare it year over year. But here's the thing, buying a home should never be about picking the top or the bottom in the market, trying to wait until prices come down or wait until interest rates come down to make your move. It should always be about buying when it's the right time in your life. And I really try to stress that in all of my videos out there. As a real estate agent, I'm not pushing anyone to buy a home, but at the same time, I know the importance of real estate and what it creates long term. So if waiting is the right move for you, just make sure you're productive while you're waiting. You're working on your credit score, you're working on building a down payment, you're working on putting yourself in a better position so that when the time is right, you're ready to strike. But on the flip side, if you're one of those people out there hoping, wishing, praying that the housing market's going to crash, and you're just here to talk crap on my videos, then more power to you. I don't think that's going to happen, so you should probably spend your time focused on things that will actually benefit you in the long run. Now, in one of my last videos, I talked about the Fed pausing, and I talked about how I thought the pause would actually be a permanent thing, as there are some top credit investors out there, again, betting on a recession coming, and this really being the peak in rates. But with that said, if you're interested on my thoughts on the pause and what's likely to happen with the Fed going forward, do me a favor and check out this video here.